All right. Good morning, everybody. Um, let's see, a couple things. Friday, we had some pretty amazing moves. This was a 15-minute chart, and down below I have volume delta. So it's cumulative delta and then just the delta. Delta and volume is taking positive volume and subtracting it from negative volume, or the difference between positive volume and negative volume, buying volume and selling volume. The difference between that generally isn't too wide, and then you'll get big orders, kind of the ones that I highlighted here. We had two big spread differences between those. Otherwise, from this is local time, so call it 11:30 market time to 1:45 market time, it was just a ripper, just a dominant buy volume versus sell volume. Not to be confused, or not to ever be said in a way that that there's more buyers than sellers, because obviously that can't happen, right? There's no such thing as more buyers than sellers. But just wanted to kind of highlight this, and there's a couple of really good snapshots from last week. This is Friday as well. It's taking these same numbers that we were just looking at and putting them in candle form. So you can see how on Friday we were just, it was just nonstop pounding on that difference between buy volume and sell volume, right? That outweighed heavily one-sided. Good stuff, right? Good stuff. There was also on Spot Gamma, they had this chart here, and it's got the VIX in orange fading down, and it has the SPX in candles with the crossover at that 4,800 structure. And once they finally diverged, you can see for a little bit we had VIX going up and we had the S&P going up at the same time. This always shocks newer traders when they think that the VIX is always a contrarian indicator, and that it's actually, you know, like in this example, moving in the same direction as the market. If it's supposed to be contrarian, it should be impossible for it to move with the market, right? Just keep in mind, generically speaking, and I never hear enough people say this, the VIX is nothing more than S&P volume analysis. That's all it is. The VIX is derived from the volume in the S&P. So it literally, that's what makes the VIX, right? The mathematical formula is looking at the volume in the VIX. So if you sum it all up and put it down into the simplest terms you could ever narrow it down to, the VIX is just volume analysis in the S&P. So volume analysis can go up the same time that the S&P goes up. Of course it can, because it's just math. It's not a teeter-totter or a fixed instrument that has to go down when the S&P goes up. They had a good write-up on it, so I'm hoping to spread that out, share it a little bit, and discuss maybe later on some of the things that they talked about. Just not now, right? Not now. We got to get to the market. So we're mostly green on the screen around the world. If we were to, start to put them in order, Hong Kong is basically flat with UK right behind it. We start getting into Europe at about 0.5%. And the NASDAQ leading at 0.75%. Now, just like I said on Friday, how we could continue even after that really nice reversal and run on Thursday, when a lot of people were saying, well, we had a nice run on Thursday, we're probably overextended now, we're going to pull back, stall, fall back down. And I was really highlighting more than once Friday that we were set up for a continuation, for an expansion day, and a big one. I mentioned the idea of a rip your face off rally day multiple times on Friday. And today's no different. The reason I'm pointing it out for today is the more people try to short this thing and then get squeezed and popped, they'll add to the pop higher. So I'm not saying we're gonna go higher, but we'll dig through all the pieces and I'll show you why we could go higher. We do have additional auctions today, and we have really that's just about it. The U.S. leading economic indicators, and then we have the auctions, and that's about that. That'll wrap it up. When it comes to things that are reporting, the account killer Netflix. When I first heard it called that, I thought, well, that's presumptuous. You know, what makes this thing so volatile, or you know, why do they give it that title? It has a historic precedent of moving beyond its expected move, even its earnings expected move by a considerable margin. So, you know, a lot of traders, they play the edge. They play, this is what a market's supposed to do, and then they expect it to stay inside that. Netflix is one of those that has a habit of not staying inside the box. It's certainly something to dig deeper into. And when it comes to lottos, going far out of the money on this thing, and literally getting, you know, the cheapest lottery option you could ever imagine trading, still has a habit of paying off. It's not the initial move though, right? It's what happens after. So if you are thinking about playing the Netflix earnings, look at what happens the next day or even in the next couple of days. It's a pretty quiet morning. I was listening to Bloomberg, and you would have thought that I was listening to a political talk show, because it was all, well, 90% of it was all about the election and 10% was about Israel. They had nothing to say this morning about the market. They casually threw in that Home Depot was lower to hold, I think, instead of overweight, and that was it. Like, it's a really boring backdrop, which kind of adds to the idea that we could continue to expand again this morning. So we got a lot of things on this screen. I know it looks very cluttered, but we want to hone in one piece at a time. We'll just start with this spot gamma indicator so I can turn it off. They brought the call wall back down. Remember, it was at 5,000 on Friday. They rolled it down. That's a negative for the markets. When they roll up a call wall, it kind of validates the idea that we could go higher, which, if you remember Friday morning, they had just rolled it up to 5,000, which kind of validated the idea that we could go higher Friday. Here we are looking at it, and they rolled it down on top of us, kind of implying that we can't go higher. We'll circle back to that, by the way. We are beyond the vol trigger, and the put wall is now equal with the vol trigger. So they rolled that thing up. Look at how tight this range is. Like a squeeze. We're getting squeezed within the optionality. And that's not necessarily suggesting that we're going to fall. We are a long ways from the zero gamma, which is all the way down. We'll just use the roundy and say 4,800. So it's almost like backwardation. Now, that word does not apply to this conversation if you were to go, you know, like study optionality stuff. They would never use that word like I just did. So I'm not saying that it is backwardation. I'm saying that this situation is very similar to like what backwardation would be like. If you're unfamiliar with that term, things in the present are generally cheaper than things in the future. So far dated things are more expensive. If you've ever traded an option, you would know that, right? Things that you could buy options for this Friday are cheaper than options for next year on Friday. When that gets inverted, when things in the front are more expensive than things farther out in time, it shows a big amount of fear or hesitation, or at least a lot of trading on the front end, that they are bidding up the front with cause. Usually this is a discussion for volatility, right? And if you're bidding up the front end of volatility, it's because you're really concerned right this minute rather than being concerned about what could happen farther down the road. So that is backwardation. When we're not in backwardation, we're in contango. Contango is we're in the norm. This situation where we're tying ourselves into a knot. We're above the 0 gamma, we're above the put wall, but the put wall is above the 0 gamma, and we're up against the call wall. We're literally squeezed in this little bitty range. Man, we could propel out of this and get to that 5,000 level by the end of the week. Sounds crazy, doesn't it? Yeah, well, it sounded crazy on Friday when I said we could hit the upper edge of the weekly expected move, and yeah, we did that, didn't. The volume today is within normal ranges, sitting at around 106 is fine. That's not extreme, heavy or light. It's just good and normal. We have a really wide daily pivot point. So I'm just zooming in a little bit so we kind of hide all the other stuff. Here is the daily pivot point. There's a channel that goes with it. Depending on the day that it had before, this channel can be really, really narrow, like two bands side by side, or it can be really wide like this. When we open above the entire structure, that's bullish. That's a generic bias. It doesn't, it's not enough by itself to do anything, but it is a starting point. We are also above the weekly pivot point, and of course we opened above it. We have not hit either one of these, which makes them MDPs. Well, this one's a DP, this is a WP. Missed weekly pivot, missed daily pivot. I don't trade that strategy, by the way, but I do use it in my analysis. This is the second day, because on Friday, we also had an MDP. That one's valid. We made it through the end of the day on Friday without ever hitting it. We now have one MDP. Just to show you an example of what that channel can look like, here's a daily pivot, excuse me, and it's a really narrow range. It doesn't look so narrow now that I'm zooming into it, but if you look at the side here, it's like 3 points wide, 47.70 to 47.73. So, really not very wide at all, as opposed to what we have today. It's really wide. We are inside week breakout. So we're above the 10-day moving average. We're above both of the pivot points. We've broke out on the week. All of this is bullish. When we look left, we're even breaking out of our own Globex structure from the overnight. If we were to look at my trend day checklist, some of the criteria is that we are outside of the previous day's range, and that what we're getting ready to or already have broke out of our own Globex range. Trends can reverse. A trend day check is not the same as I see trend. Like, oh, wow, look, there's trend. Trend can be found anywhere. A trend day is a specific concept. It has rules, has criteria. So far, we have those conditions and those requirements. We need a catalyst, though. So I'm really watching the news, looking for something to come in and light that spark. All right, so we need some levels for today, some upside targets. One of the things that we can do, just really simply, is measure last week's range, and that will give us projections to the upside. We can also come in and we can measure just Friday's range, and that also gives us levels to the upside. There's a couple of things worth noting while we're out here on the daily chart. Notice there's no wick to the bottom of the current candle, and that we have not yet closed this gap. That's bullish in one sense and not so bullish in the next sense. So the candle with no wick, that's bullish. Not closing that gap is bullish. But on the other hand, gaps kind of owe us a fill at some point. Now you can go back and you can find gaps that have been around for years that still have not filled. So don't get too hung up on an idea that it has to fill. I'd rather have a gap up like this at the bottom of a range or the bottom of a zone after, say, a red day and then a gap up and a run. I'd rather have that kind of a gap up rather than gapping up after a really big move. There's a day where we had it right there. So a really big move and then a gap up. It wasn't much of a gap, just like today. It's not too much of a gap. It did fall, rally, fall some more, and close more of a spinning candle, like a spinning top, than it did anything else. It's very likely the kind of day that we're going to get today, but we could expand more. Notice back here where I was talking about how many days in a row that we just kept grinding and grinding and grinding and grinding higher. So I'm not saying don't short it or that we can't go down. Just try to find a better reason to short it than the idea that we went a long way to the upside. That can't be the only reason you try to short this thing. $10-day, 30-minute volume profile. We are well away from the point of control. We are building pretty much a classic D shape. But if we continue to hold this high without expanding higher, we're going to slowly begin to build out a B shape. We're going to lose this volume down here along the lows. That's going to tighten up our zone considerably, in which case it'll be a lot easier for us to continue with that B shape, looking to build this zone out in volume. If we do fade or fall back, a lot of optionality suggests that this is a significant wall of support, 4,800. So it's not impossible to break through, but we would need something really negative to drive us through. That's really something to consider. 4,750 was the wall that held, and now it's moved up, right? So 4,800 is the new wall. The optionality doesn't specifically say, like a call wall. So I should probably use a different word. 4,800 might not necessarily be the options wall, but it's the line in the sand, right? That's the structural level, not just with options, but with this point of control, with a lot of other pieces too, that when we measure things out, use our drawing tools, this level comes back again and again, 4,800. When we leave a shallow area behind like this, we can fall through that really quick. Notice the point of control is up here at the top. If we get back to that point of control, it's very likely going to be a first touch play. There's a lot of unfinished business there. That's where the bulk of all the trading happened. It would make sense that if we get back there, people who traded there before are now going to be confronted with the trade decision that they made earlier. Think about how you would react if you had gone short there and now we're back. Think about how you would react if you had gone long there and now we're back, because that's the same situation that everybody who traded there is now going to be facing if we get back to that point. It is a VPOC. It's an untouched point of control, so we're going to mark that out. $48.67 and 2 ticks. If we break that structure, we'll fall through it really fast and we should be able to get to the cog line 48.11 relatively easy. We'll find some structure near the Globex high from Friday, 48.50. But barring 48.50 holding, I would expect, 4,800. Kind of loose with those numbers. Let's tighten it up. 48.40, not 48.50. We should find some structure around this zone. That's about 5 points. After that, then we can get to Friday's low. And from there, we can use measured moves and start hitting those targets to the downside. But this shallow area, there's nothing in there to help us out. So breaking that VPOC, we should move through it to the downside as quickly as we moved through it to the upside. Notice this morning, this really tight band. So this needs to stick. It has to keep. And so far, they're doing a good job of building the structure here so that it's not so thin. But we don't know how strong it is yet. All right, so as I mentioned on Friday, we reached the weekly expected move. We went from Thursday, where we had closed the previous Friday at 48.11, and we made an entire week's move on Friday. That was how far we should have worked our way in an entire week, and we did it in a day. Some pretty strong flows. So last week we measured this range, but it wasn't set in stone. It doesn't set in stone until 4:15. So now that we are in a new week, we want to measure last week's range, generically speaking, and just set it on top here. Now, the current week has 5 days in it. This is a full trading week, and last week only had 4. So the range is expected to be a little bigger just because, well, we're measuring more days. But that's barely bigger. The volatility this week is less than the volatility of last week. That's an off-the-cuff perception from this, right? It's almost no difference, which means that there's an entire day of volatility that was able to get tucked in there and we can't even see it. That's how much lower the volatility is. Lower volatility is just a bullish posture, right? But lower volatility is also less movement. So the idea that the day-to-day candles would be smaller. The distance from 10 average continues to shrink as we've come through this last contract. How far we get away from the 10 before we flip and reverse and go back to it, like mean reversion, has gotten less and less. So right now we are 1.4% from the 10-day moving average. That's a significant change. By, Tuesday last week, we were still below. Or maybe it was Wednesday. That's the 17th. Yeah, Wednesday. So on Wednesday last week, we were below. And now we're above it, almost 1.5%. It is the 10-day, though. We change that quite a bit. You can see the crisscrossing back and forth all the time. That blue line tends to run in a bit of a trend. It's rare that it would move to one direction and then suddenly sharply change direction and go somewhere else. There has been times where we didn't get a crossover, like say right there and here, where we've moved like we were gonna cross over and then we actually didn't cross. So there is times where that's happened, but most of the time When the blue line is coming down, it crosses. On those times where it didn't, you'll notice that it was often like this zone here. It's a curving gently, and then it just kind of ricochets off, as opposed to, say, something like this, where it's a sharp, just very steep decline, steep crossovers. Well, look at our current structure. We're just easing down into that zero. Very likely we bounce off of it. And a bounce off of it sets us up for a bullish structure. This is more than just price hitting the 10, right? Because that's what these histogram bars show, is when price hit the 10 or crossed above or below the 10. I mentioned on Friday that we are very likely not going to get back below the year-to-date VWAP for a long time coming. I don't want to say that we're done with it for the year. Even if you look at last year's, at some point, you know, I think we went back down and challenged it a few times, but for half the year, we held above that VWAP really nice, that year-to-date VWAP. And I think this crossover that we had last week is going to be the last one for a while. Obviously, time will tell if I'm wrong. But if we take that and this blue line that I was just discussing, and a lot of the other things like, the dollar index, the 10-year, some of the breadth tools that we use, like moving balance from stock charts and advanced, say, small caps, growth versus value, everything's pointing to this, not just the ES, but the S&P and the marketplace expanding to the upside for at least a part of this year. Very likely that we keep expanding until they actually cut. As funny as that sounds, you would think the cut would really galvanize us. But I think that's going to be when it starts to unravel it. We'll see. So we're looking at 5-day change on the 9 sectors. Utilities down 3% over the last 5 days, with a consistent, persistent sell-off. The 50s under the 200, prices underneath all of them. That's just, the most bearish signal you can get. But at some point, we mean revert, right? So, right now it's all tech. Even this morning, the NASDAQ is up more than the other indexes. But if we're going to get that capital rotation, if we start to see even a fractal rotation, I'd be keeping my eyes on utilities for the opportunity, to take a play. Short duration, of course, but I would rather take things long that are down significantly in a trade than try to take things from their highs to go higher, right? It's not to say that I won't. Momentum plays, you got to buy high and sell higher. And then tech is up over the last 5 days, 4.5%. So consistent, persistent move to the upside for sure. 50s over the 200, prices above both. That's a bullish structure completely. But at some point, this is going to stall out. It doesn't owe us a stall today. Let's just kind of keep that in mind, right? Same thing with this. It's going to mean revert at some point in utilities and come back up. It doesn't mean it has to be today. Keep your eye on Japan tonight, or at least have them in your considerations for any swing trades that you want to do today. Say for Friday expiration sort of approach to trading, because with the Bank of Japan announcement tonight, they could interrupt or interfere. Okay, well, that makes me feel a little bit better. They're down this morning. They were challenging that 148.5 last week, and that gets us into intervention levels. And the worry would be if they come in and intervene, then how that affects the marketplace. They do have an announcement tonight, though. We'll hear more about maybe what they want to do with this, or what they plan to do. They lie. All of the Fed do when it comes to this. They will tell you, no, we're not doing anything. We're not doing anything. Then they'll do it and they'll say, well, yeah, okay, well, we did it, but we couldn't tell you ahead of time because then you would have front run us and it would have screwed us up. So we had to tell you we weren't, and now we're telling you we did. Japan is one to deny. If you look at their October 2022 intervention, they denied until literally the evidence was thrown in their face that they did it, and then they said, oh yeah, we intervened. You got me. So maybe they'll give us some insight today. At the very least, maybe somebody will question them today and draw out what this pull off was here from Friday. Who knows? Maybe they already did intervene. And I'm not picking on Japan, right? Christine Lagarde does it. Powell does it. They all do it. Nice expansion in bonds this morning with stock. So this is going to have to give us a little bit of concern. We got stocks and bonds both moving in the same direction, both breaking out nicely. I mean, they're not greatly exaggerated breakouts, not like yesterday or Friday. Not yet, anyways. And in Friday's case, it actually had fallen back in deeper than the S&P and the NASDAQ did. But V bottom recovery from around 330 this morning, right back up and continuing on the breakout. Normally, you'd get something like stock bond, divergence, right? You'd have one up, the other down. That's where your risk parity comes in. But we've said before, risk parity is dead. It died with COVID. So if all the money is going towards bonds and then stocks would just not run, kind of chop sideways, or if all the money went to stock and bonds just chop sideways, that would make sense. When it spreads out like this, it kind of brings me back to my argument that today could be another expansion day like Friday was, especially if people are trying to short it, because they'll just get caught in the short squeeze and add to the buying when they finally give up and capitulate. If we get a broad market rally where everything is trying to come up, there won't be anything to short. It can be a grind higher where they just keep lifting their orders up as we grind, right? So I would keep my eye on bonds today. If we do start to see a divergence, that could signal a change, not just in bonds, but also in quote stocks, whether you're looking at the NASDAQ, the S&P, or even if you want to go into something else. For a continuation today to the upside, I'd like the dollar to actually break that 103 and start expanding lower. And we want the 10-year back below 4%. Now, that's not saying that it has to get there today, but I want it moving in that direction. Same thing with the dollar. I want it moving in that direction. For US dollar Japan, at this point, off of that high, it can just hold the line below that 148. That's a really good start. I'm not really looking for more than that at this point. If it gives it, sure, we'll take it. A continuation down below that 147.5 would be great. But even just holding below that 148 is a really good start. And if we're going to approach things from that point of view, come back to the dollar and say holding below 103.5, we want to do that. With the dollar back above 103.5, I think it's going to shut down this S&P, NASDAQ, quote, this stock run. And for the 10-year, if we're going to just draw lines in the sand, then say above 4.2. If we get above that, it's going to shut this down as well. Right. So kind of lines in the sand gives some structure. Notice here we've got the indexes. That nice expansion from last week in the S&P and the NASDAQ. But the Dow, in that expansion, it was just getting back to the top of the range. It wasn't expanding beyond the range like the NASDAQ and the ES. And for the Russell, it's not even back up to the top of the range yet. So if we are going to carry this bullish bias, the Russell is the one that has not yet performed. Sometimes that can be the trap, but sometimes that can be the play. So think about this as a scoop pattern. We're not even done with the scoop yet, right? But it would eventually form a cup and then perhaps a little bit of a handle. So the target would be 2100, but even just using something like IWM, we could look for a long play in IWM, maybe even just like a legged in iron condor risk-free. I like risk-free trades. So let's just kind of clean this up a little bit. We do have a market maker move on IWM this morning too. Shows they're hedging in the front end. Just trying to get some structure here. All right, so we're underneath the 10 and the 20, but we're above the 50 and the 200. So we're looking for a 10-20 cross in price first. It's going to be bullish just getting a breakout above the 10. That would be a good start. For that scoop pattern that I was just talking about, Thinkorswim's not showing the new candle yet, but there's already a candle forming right here, right? So we're already starting that curve back up. We could target something like 204, 203. Oh, that's crazy cheap. We're talking 4 or 5 pennies. And as we get into the open, you could probably work that order and get it even just a little cheaper. Since they are that cheap, there's nothing wrong with going closer in. Going closer in isn't going to make you lose, right? It's not even going to make it a harder trade to win. You're just putting more money on the line. But I was looking for a cheap lottery, and I mean, these are drastically cheap. So using even something like the 200 strike, generally it's going to have more open interest because it's a round number. Tom Sosnoff talked about that a lot, which I found just shocking and amazing. But there you go, round number either in the options strike and or a round number on the options price, like $1 options get traded more than others just because they're $1 and it makes for easy math. So says Tom, right? Who am I to argue with the guy? He's a genius. Still is pretty cheap if we can get it running. And look, there's no reason to go so close. I know I'm looking at this Friday's options, but you can always just add time and use, next month's expiration. They're a little more pricey at this point, but you're not going to have that hammer of negativity just, trying to bash every penny of extrinsic out of it on a day-to-day basis. Gives it a little cushion. For a legged in iron, let's just kind of discuss this. I like an at the money put credit spread on the bottom side. You want to collect 50% of the width of the spread in credit. So if you make a $5 spread, collect $2.50. That would give you a trade that needs to close higher than, say, 192. We'll just draw a line. That's our break even. So then when price comes up and say it stalls across these highs, you put on a call credit spread at the money, collect half the width, and make it the same size as the one you made on the bottom. In my example, $5, $2.50 in credit, do the same thing on the call side. Now you have a risk-free, no-lose trade. Either price closes inside your range and you make all of the money, or it closes on the outside of either range and you lose nothing. You can't lose. So you'll either win or you won't lose, which sounds way better than you're either winning or losing. That's a legged in iron. The tricky part is duration and timing. But at the bare minimum, buying some calls around the 203, 205 area, even just getting a call debit spread, since they're a little more pricey out at this level, you're looking at $15 for a debit spread. So you're risking $15 for a chance to make 40 or 50. That's not a bad return, right? And you're not even really risking the entire $14, because if it starts to collapse, you can just, cut this at, say, 50% loss. What, $7 plus commissions? Yeah, okay. You're not breaking the bank there. So you can run it that way. You could just do an at the money call credit spread, call debit spread, just buying that same call spread, but at the money. You could just straight up buy a call. They're not that expensive. Or you could do a put credit spread. I like my put credit spreads near or at the money, but if you use, there is a micro, I don't remember the micro symbol, but there is a micro, just like there's XSP micro for the S&P, there's one for the Russell. That one you cannot get assigned, so you can build your put credit spread in the money, which is really cool because it's cash settled. There's no assignment risk whatsoever. Let me grab Google real quick and see if we could find that IWM mini. When you know it, the day that I want to find it. Anyways, it's not crazy liquid because it's not a well-known product. Even XSP is not as liquid as the SPY or the SPX just because it's not so well known, right? But these mini index options, they're like European settled, so they're cash and they're not assignment risk. You can build your credit spread in the money, and worst comes to worst, you're just going to get cash settled. Yeah, I'm not finding it right now. We'll find it later. Another morning, perhaps. But that's what you could do. You could trade the mini IWM version and build your put credit spread in the money, collecting like say $75 in a $1 wide spread, which is awesome because then you're risking $25 for a chance to make $75 and it's all credit. So you really don't need too much of a move other than for price to get above your break even, wherever that happens to be. I wouldn't recommend doing it with IWM because you don't want to build your put credit spread in the money on something that could be assigned to you. That far out in time, you're very likely not going to get assigned anyways, but as we drift closer and closer to expiration, that would become a more serious risk. I know that this looks like a sloppy mess, but when you use the regression line tool and start at the beginning of all of this, the line is sloping higher. This is grinding higher. And just for a moment here, let's just remove all this stuff. A bit like a megaphone pattern. So, think about how we expect price really to be in a range. And what it tends to do is expand beyond that range a little bit more and a little bit more until finally something breaks. And that's where we get that megaphone pattern. At this one, this isn't perfect, just kind of slop it on there. But we were compressing and then we broke to the downside. Now we've broke to the upside. We've got equal sides, like a reciprocating saw. We've got an equal break on each side, pretty close. So we're right back in the middle again, volatility wise. We want to see this change in structure. I'm going to add a little bit of caution here. We had the same setup started. We even had the up day, and then it all collapsed. So here we got the same structure. We're starting to get that up day. We could even get, up to 200 and then watch the whole thing collapse just like it did there and there. Shoot, even here, right? Same structure. 2 or 3 days to the downside, one big up day like it was going to form a scoop, and then it just collapsed. So be careful with this. All right, Bitcoin, China ADRs, gold miners, those are all down this morning. And the things that are up, finance and tech, which are two really big ones. I should say banks, not just finance. Banks and tech, those are the risk on sectors that we need for another rally day. It might be. Let's see. Is that I don't think it's this one. Because see, there's the NDX and then there's the micro NDX. And then there's, like the SPX. So this is the full size, right? No, it's not. It's not the full size. That'd be a mini version, wouldn't it? It'll work. Thank you. It'll work. Let's use it. So the MRUT, No, that's the footsie. I don't know. I don't like that footsie on there, but it is a miniature version of the Russell. Let's check. I don't like that it says footsie. So here's the Russell. Here's the M Russell, the MUT. If it's tick for tick, it is. Then that'll do it. Yeah, we can use that. Oof. Where's the volume in these things? No volume? Okay, well, without any options, we're not even getting stats. It could just be a load error on Thinkorswim. Hmm. You know, we might even just want to use the options on the futures if this doesn't get cleaned up, because I'm not getting any options data on those. But otherwise, yes, I think that one would work. I'll check with CBOE today too. So this continuation that we had on Friday with semiconductors and tech, it's the same thing that we have this morning, but we have bonds too. So we can see the NY Fang group, the little homemade ETF that we use. They're gapped up this morning as well. Yeah, that hit its levels. So I've talked pretty bullish this morning. Everything that we've been discussing has really just been about a continuation to the upside, but it's time to play devil's advocate before we wrap all this up for the day. While I see that we could expand to the upside in a continuation from Thursday into Friday, now into today, the other side of the coin would be if we just tank, right? That the market decides they don't like something that comes out this week, they don't like some data, something, even this morning, that there could be something that comes out that they could just change their mind, right? Some lose that warm, fuzzy feeling, and we start to drop. So the ADR half is 48.96. We could hit that and then tank. We could just chop about here within this zone for the rest of the day. It doesn't owe us a continuation today. All it has to do is hold the line. But if we break 48.70, then we'll target 48.50. And if we break 48.50, we'll target the full ADR 48.25. Along the way, we can stop at these various levels, 48.60, 48.34. So we got some targets to the downside. Even if you want to start it early, we've got this nice cluster here. All we have to do is break back down below 48.87.5, and we can target this half back, 48.44, then down to 78, and then on down from there, right? Level by level. So I see a bullish posture this morning. We're set up for a continuation, but it doesn't owe us that. And you're going to want to watch the options flow today, just like how Friday, the options really highlighted what we were working on. And keep your eye on that volume delta. We have positive deltas this morning so far, but that can change as we get into the open. Just to highlight that change, then we're done. I'm gonna get off of here. At 9:30 on Friday, we were still getting negative prints, right? And quite a number of them on a 1-minute time frame. There was a lot of 1K and 1100, 1200, 1300 prints. If you look at the delta on Friday, it was a lot of sideways action, which is kind of a grind in there. And look how negative it got before it turned positive. So it can be a heads up. So what I got for you guys, be careful, be safe. I will see you all tomorrow.